What's going on in the economy is a top of mind for everyone. In today's conversation, we're going to talk with economist Tim Mahidi to share what he sees and how he's viewing the impact for the equipment finance industry. I hope you enjoy. Hello, and welcome to Equipment Finance Matters. I'm Kelly Nienaber, Senior Vice President of Industry Advancement and Executive Director for the Equipment Leasing and Finance Foundation. I'm looking forward to today's conversation on the economic outlook. Joining me is Tim Mahidi. Tim is an economist by trade. He's founder of Access Macro, and ELFA is partnered with him to serve as ELFA's fractional chief economist. Tim, welcome. Will you introduce yourself to our audience?
Yeah, so I'm Tim. I'm a recovering Fed economist, as I like to say. I've been doing this about, let's say, 16 years. I was at the Fed the San Francisco Fed a few times, the International Monetary Fund in DC, on Wall Street for a little bit. And at one point I served as Mary Daly, who's the San Francisco Fed Chief of Staff. So I've seen the economic landscape from various vantage points. But I will say I have learned an enormous amount, even with all of that. I have learned an enormous amount as ELFA's fractional chief economist. It's just been a real interesting experience so far. I'm having a great time. So I'm excited about today's conversation. Thank you for inviting me on. I think we're going to be doing a bunch of these.
Yeah, we're super excited. I know you've been working with ELFA for a couple of years on the CapEx Finance Index, lovingly referred to as the CFI. And recently, you and I had the opportunity to develop and produce this new economic outlook product for ELFA. And that's what we want to be able to talk about today. To get us started, let's just kind of set the stage a little bit for our listeners. Talk about what it means to be ELFA's fractional chief economist. I know you've been making the rounds at conferences. Share what your role is there.
Yeah, it's been really interesting. I'm not blowing smoke when I say this. There's the things you can learn in an economic textbook, the things you can learn doing the job out in banking, which is kind of my background. And then there was joining the ELFA and learning how this industry works. You can't just open up a book and see, oh, this is how equipment finance works. This is how the equipment industry is, right? This is how you finance that. So I remember one of my first days, I felt like being dropped into the deep end of the pool. I was Googling terms, trying to figure out, what's a small ticket? What is it? How do we think about, it was all over the place. And it was really fun, actually, because it was, it's nice not to have staleness in your career. Mm-hmm. I've just recently crossed into the 40s, and I can say, it's nice to say, hey, I feel like I'm getting a bit of a second career getting to come in and do this with the LFA. So it's been really fun. And we've been thinking a lot. I think one of the things that's great about your organization is there's a lot of forward-looking, forward-thinking mm-hmm. folks, and the agenda is very ambitious. So one of the things that I have really enjoyed working on, both on the CFI, as we affectionately call it, and on this new outlook that we're doing that we're going to talk about, is it's been really fun to kind of just brainstorm. We've got a lot of greenfield, and just kind of say, hey, is this working for the membership? Is this working for the objectives of the organization? Yes or no? Okay, let's see what else we can do. And so it's been really fun kind of experimenting with you all and figuring things out and growing the various things that ELFA is up to. It's been a blast. I've really enjoyed it.
It is a very interesting industry, and it's a $1 trillion industry. It's been growing for a while, as long as I've been around, and we're in the process of updating our market sizing study. So we'll have some new data to share with everybody later in the year. But today we want to talk about this new economic outlook, and with your background in Fed policy, we want to be able to lean in and hear from you on your insights and expertise. But for the product itself, for those who have not yet downloaded, it's available for members from ELFA's website. I encourage you to check it out. It's formatted as a PowerPoint deck, and it has some talking points and some analysis right there in the charts. Obviously, in this podcast format, we're not going to be able to look at all of those charts, but people can follow along if they want to download the product. The intention is we will update that deck quarterly. Then, Tim, you and I can have these quarterly conversations when we publish a new outlook. And then we're going to weave in a web seminar as well. So then we will have the opportunity to take some live Q&A and to be able to share your insights with those charts the way you've been doing at a lot of ELFA conferences. I'm super excited about that, and I want to just jump right in to where we kicked off with this initial outlook that we just published a few weeks ago. Sound good?
Yeah, let's do it. I'm excited.
Okay. All right. Top of mind, very big daily issue. How does the end of the war change the forecast for the economy and inflation, all of the things? Let's just start big.
I was going to say, you start off with the easy stuff. I thought we'd do some softballs. Go to it for a couple of years. We're recording this on a certain day. I'm not sure exactly when it will come out, but things could change rapidly in the period
Sure.
in that period of time. But let's assume that hostilities are done. The Strait is officially open again. That's the big one for near-term economy. I'm going to stay off all the geopolitical, global security stuff. That's not my background. And so the first thing you have to look at is inflation, right? I mean, this was a classic energy price shock. I've talked about it at a few ELFA conferences. This is kind of like textbook macro. Hey, you close the strait, you clamp down the supply of oil and gas. So then, bang, immediately that shows up in headline inflation and energy and gas, and then it's starting to show up a little bit in the secondary and tertiary kind of core inflation in various places. You hear stories about airlines that may have to increase fares, or folks that are agriculture are going to have to increase because of fertilizer costs. Those are the kind of secondary and later effects that happen. Now, that was the forecast a couple weeks ago. What's interesting is we haven't hit the full amount of those shocks yet, and there's a good amount of psychological aspect to this, and companies are forward looking. And so with the end of hostilities and oil prices have come down substantially, there is a good argument to be made that maybe those pass-throughs to core inflation, the other sectors of the economy, won't look nearly as big as we would have thought 2 weeks ago, because everyone's going, oh, the inflationary shock is done. Now, I'm not saying that's what's going to happen. There's still other things that could be going on, but it definitely, the first thing when we're talking about the end of the war is it substantially reduces the inflationary pressure we're feeling in the economy. It also should help with consumer and business sentiment, which has been negative.
Okay. Yes, I would say we've seen that almost immediately at the gas station, in airline prices. And what is the normal time frame where you see those adjustments, like immediately at the gas pump? Yes. But what's the time frame to see it in other ways?
It's such a good question. I wish economists had a more, one of the things that's been hard in the post-pandemic world is all of our models are trained on, decades of data. And we just entered what economists call a regime shift, what everyone else calls a structural shift. And so all those models are kind of broken. And so when we're thinking about like, okay, what's the timing and how these things work, that has changed in some sense. And I think I talked about this at the ELFA conference as well. We have a good chart in the chart deck. I think it's a really important one to look at. It's on corporate profits as a percent of GDP. Corporate profits as a percent of GDP is very high. So that means companies have a ton of buffer to absorb these things. And so what makes this complicated, and the same is true of tariffs, what makes this complicated is companies, and the first line of folks that feel both the tariff shocks and the oil price shocks are businesses. And then the question for both policymakers, economists, and the rest of us is, how much of that do they pass on to those of us who are showing up to buy the blueberries or, gas pump inside that automatically, just like you said, or, going to buy tickets. And that, traditionally it's been like 2 or 3 months, but the tariffs were longer. I mean, we had tariffs in April. We didn't really start seeing that inflationary impact until December, in my view.
Well, let's talk about the difference. I mean, we're reacting as consumers, but when you talk about business confidence and ELFA's monthly confidence of industry leaders versus the consumer confidence and what you have been seeing in the CFI as we track that on a monthly basis, how are you seeing that data change and shift with these reactions?
It didn't start out this way when the team and I put the deck together, but it has turned into my favorite chart in this outlook because it so perfectly encapsulates the bifurcation of our economy, right? I mean, anyone listening has probably seen the millions of headlines. The consumer confidence is plummeting. The stock market's up, wealth is super high, but real incomes are now negative again. Consumers are really mad about it. And then you go and you look at some business sentiment, and it's like, not only is it fine, I think the latest MCI, we had another increase. It's 2 months in a row now.
Yeah.
Right, so you could actually see in the data. This is a really interesting series because you could see the April tariff impact in the MCI data. Then you can see the rebound after everyone kind of goes, "Whoo, not as
Yeah.
bad as we thought." And then you can see the wars impact again, and now we're coming out of that. And so, like you're saying, there's a real gap there between how consumers feel and how businesses feel, particularly businesses in this industry, right? And I
Yes.
don't know. Do you have this is a question that I always hear, and I've always wanted to ask, like, what is your take on why this industry is so resilient? Like, it just feels like it just keeps pushing through no matter what.
Well, for as long as I have been around the industry, the performance metrics have continued to grow. Equipment leasing as a product is something that is very attractive because of its resiliency and the ability of the equipment to maintain value when there's an economic downturn. So that is definitely something, and we've got research that shows those performance metrics over time, and this has always been the case. It's a fascinating thing and something that's really attractive about the industry. I'm going to shift gears just a little bit. There is a new Fed chair. Want to talk about what that looks like. I know they just had a press conference. They've had their first meeting. What is your key takeaway from kind of those first several weeks, I guess, over the last month and what that looks like?
It's going to be different. That's the way I can summarize that. It is really remarkable how, people are going to have all kinds of, this Fed chair is going to be very opinionated and someone that's going to induce or cause a lot of opinions. He is not coming into the situation waiting to see what's going on. Mr. Warsh was at the Fed right before the full gold financial crisis, was one of the people that got us through it. He hasn't technically worked with anyone on the committee, but he's well known in the inside the Fed, and so he's got those connections. But he's had these plans, and he's been thinking about this for over a decade. So he came in and he came out in that press conference very aggressive. He's got a task force with 5 different things they're going to cover, everything from how the Fed communicates to what data they're looking at, which, private sector data is apparently going to have a much higher weight. ELFA actually sends the CapEx Finance Index to the Board of Governors. They requested that from us. So that's the kind of information that I think will start trickling in more to the FOMC boardrooms. That's a big one for the industry. And I think we're also going to hear a lot about balance sheet stuff and about, Fed policies that maybe are known to bankers and people in the industry, but less to the wider world. So I expect some balance sheet talk. What will be really interesting, though, is that was the most hawkish press conference we have had since 2023.
Okay.
It was very, very hawkish, and that is not what the administration is currently looking for. So that will be something to watch over the summer. How will he came into the Fed saying he wanted to reduce rates. That was his view. There are folks on the committee that may agree with him. Then this war happened, inflation happened. So perhaps he's responding to that. But that was really surprising to me, just how much he leaned in that hawkish stance. I
Okay.
think that's going to be interesting to watch how that plays out with all the other members.
So, from your perspective, kind of watching all of this evolve, where do you see interest rates going? That's always a popular topic every time we talk about the economy in the industry.
We were early on this. We've been banging this inflation drum for a little bit. I was concerned last year, that the Fed was doing maybe a little too much and they were going to have to turn it around. Not that the policy was bad. I mean, we've been in this spot of inflation and labor market being in tension, right? We had a weak labor market and high inflation. That's not usual. So the Fed had to kind of set bad choices. And as we crossed in the year, it became clear to me that the markets were going to have to adjust, particularly after the war. And they did. You could see Fed futures markets went from expecting 2 cuts the day before the war to expecting one raise a week later. So it's a 75 basis point swing in market expectations. And now we get to, with Mr. Warsh, everyone, and what was just transpired, markets are repricing things to go, maybe even up to 2 cuts. I think that's a bit aggressive. I think the floor is no cuts, and that should be pretty well. I don't think there's a good argument at this moment for a cut this year in terms of how the FOMC is viewing the data. But I think the bar for a raise is still higher than it may seem at this moment. So
Okay.
I think no movement is probably the best forecast. But if you have to pick a movement, I would say up before down.
Okay. Can you explain a little bit about the task force that's been put together and kind of where their direction is and what they are looking for and what that means and what it might mean for equipment finance companies?
Yeah, there's still not a lot of information
Mm-hmm.
about this coming out, and that I think took everyone I have talked to, it was blindsided. So
Okay.
I have to put this in context. The Fed goes through, or used to go through, every 5 years something called the Monetary Policy Review, where they would look at all of their the entire way in which they do policy, they conduct policy, and the tools, and then they would say, hey, we're going to make changes or not. They did it in 2019 and 2020, and they did it again last year. And really, when they went through it last time, again, last year, they came out basically with no changes. So the idea going into this was that Mr. Warsh had a high hill to climb because the Fed just evaluated their business and said, we're not going to change much about it. They
Mm-hmm.
also just stopped quantitative tightening in December. So there was a lot in there that Warsh had pushed on. So folks were, I think understandably saying like, hey, look, he's not going to make changes. The task force comes out and basically opens that whole door again. It's like another monetary policy review. They are looking at everything. They're looking at the balance sheet. They're looking at the data the Fed's ingesting. They're looking at the communication style. They're looking at all, I have to go back and look at exactly the 5 things, but they've got a very broad set of things they're looking at. And interestingly, he made a lot of, he put a lot of time into saying it's not just going to be economists. So there's going to be that's also kind of a new take, right? There have been other non-economists that have kind of weighed in, but this sounds like there's going to be a lot of non-economists,
Okay.
communications experts, things like that. So what that means for the industry, I think, is still an open question. But uncertain. It brings in a lot of uncertainty, which gets priced into rates, right? So
Sure.
more uncertainty, more term premium, more risk means harder to bring rates down, or even upward pressure on longer duration or medium duration rates. So I think that's how I would be thinking about what we know at this moment.
Okay. Well, let's think about this in the context of ELFA's economic outlook and the resource that we want to bring to our industry audience. We published the first outlook in May. We're going to do this on a quarterly basis, so the next one will be in August. And we're having this conversation to kind of help bridge that time between May and August. So, what are you looking for? And obviously, I mean, if we all had a crystal ball, we'd all know what we were doing. But as an economist, from your perspective, what are you looking for to show shifts and changes or trends that as an industry we need to be mindful about as we move from quarter to quarter with these outlooks? Like, how can we help our membership use and leverage this resource as a means to track what's going on and strategically leverage it for their business decisions?
Yeah, that's great. I'm trying to form my thoughts for a second because we talked about this. So we had a big
Mhm.
discussion around like, well, okay, how are folks using the Outlook?
Right.
And I'm going to put this I'm going to put this in greater societal context first. That's I think why we chose this. But at this moment, there's a bunch of things between LinkedIn and AI that create a ton of content. Right, opinions are everywhere, content's everywhere. It's hard to discern, and also uncertainty is super high. Right. So you've got all of this uncertainty happening in the background on economics and politics. Then you've got a lot of takes on those things. It's
Mm-hmm.
not always clear, and then you've got to make decisions as in this industry, 5, 7, 10 years out, right? So like that was already hard to do. Now it's even harder for these two big reasons, right?
But we're resilient. We'll figure it out.
You are totally, totally. And I think the purpose of this was to create a document or set of materials that would help folks have better conversations inside their organizations, right? So we're gonna, cards on the table. The crystal balls were bad before; they're even worse now. But that doesn't mean that you can't have strategic discussions. So our idea was let's make the economic outlooks kind of closer to what the industry is experiencing and how they impact the industry. Let's do them regularly. Let's have kind of a rolling outlook on how the economy is instead of like this quarter, that quarter. Just kind of what do we see? What are the big themes? And then produce materials that can be used by non-economists inside their organization quickly to have those discussions at strategic meetings, board meetings, whatever it is. So that was really, I think, the nexus behind why we chose to do what we did and what we hope is a valuable resource for folks in the industry to have those discussions. But, there was a lot that went into that conversation. So I don't know if there's anything that you heard or saw that you want to weigh in on or like why we made this pivot.
Right. Well, so far the feedback has been pretty positive, but it is a new product. So if our listeners out there have the opportunity to download, please share your feedback with us. We want it to be a utilized resource in your strategic planning. And obviously, we will be updating it on a quarterly basis. And you'll see different formats, whether it's that slide deck that is downloadable from the website. There's an executive summary on the website. Tim and I will be having these conversations. We'll also have a format where there's a web seminar and there can be some live Q&A that will invite people to join in. So a variety of ways to both keep people informed and collect the broad feedback from the industry so that we can make sure together we're all advancing and evaluating all of the things that we need to consider as we move forward. I think that's been the goal, and we're just getting started with what that looks like. So certainly welcome the community's feedback as we go through that. Tim, I want to ask you about the uncertainty that you mentioned and you talked about in terms of the geopolitical factors that are happening right now. What does that mean for the dollar and just the global reserve currency?
This has gotten a little bit lost. It kind of peaks up. This conversation kind of peaks up. Get ether now and then something else, crushes it. But there is potentially a rotation happening. So, not to play history teacher. My dad's a history teacher, but I will try to stay in my lane. Going back in the post-World War II world, the U.S. was kind of the last country standing, and we made an investment in the rest of the world through the Marshall Plan and Japan and other places and oil markets. And that was our big kind of golden age. And because we made that investment in the rest of the world, they used our dollars, right? And some countries even moved to dollarizing or pegging to the dollar in different places. So, and the oil markets all price in dollars, right? So there's a lot of demand for U.S. dollars, which helps our economy, right? It helps keep our dollar appreciated. It also creates demand for our, fiscal stuff like treasuries and things like that. So there's demand for those things. Now, that's not going to be unwound in 5 years, right? But there are early signs that there are potentially shifts happening in the global economy and not in the geopolitical space that are reducing the demand for dollars. Now, it's been interesting because, traditionally the U.S. financial market has been a flight to safety. So you would say like, okay, increased uncertainty, people flood into treasuries. It's the closest thing you have to a risk-free, rate. And so that still is happening to an extent. But when you look at who's doing it, that's where you start to see this kind of shift. So traditionally, foreign central banks have been a very strong source of U.S. treasuries, very high demand for dollars because of this dollarization that we talked about. There's been a slow leak out from these kind of central banks in their need for dollars. Now, the foreign private investors have actually picked up the slack and a little bit more than that. So that's where it's like, okay, we're seeing some rotation over. Overall demand is there. But those are also the more volatile of investors, right? The global economy, we think all about the US, but what happened in the Strait of Hormuz impacts the rest of the world, particularly Europe, a lot more than it does the United States. And so if there's a shift in that demand and the rest of the world kind of falls off a cliff, that there could be an outflow of that demand, or there's a reduction in the ability to buy U.S. treasuries at a time when the central banks, which kind of go through crises, that like load-bearing demand is gone.
Mm-hmm.
And so as you talk about that, you hear about whispers from Iran and China wanting to move markets out of the dollar, move the markets out of the dollar. Those are the kinds of things that could be the beginning of a reduction in the demand for dollars that will take decades to unwind. Now, this I think is could still potentially be a moment in time or reversed, but it's the first time that I can remember to see that kind of like just question marks above people's heads, like comics. Do we need to be using dollars? That's not even a question people asked for 50 years, right? But now we're talking about, do we need the dollar? And I think that's a curious thing to ask.
That, well, it's not a perfect segue, but I wanted to ask about how you're viewing the current state of tariffs and supply chain and those sort of external economic factors, but the specific impact in the equipment leasing space.
Harris, Kelly,
I
that's a
know, I know,
2025 story. We're
I
on
know.
war number whatever this year. Um, yeah, it's interesting because there's so much of what the administration does is a negotiating tactic, right or wrong. That's what I think a lot of what their plan is, and the tariffs. It was interesting. I was kind of splitting the difference there because you would see like the initial reaction, like on Liberation Day, were for these exceptionally high tariff rates. They were almost immediately walked back, right? But in some ways, it had the impact that it wanted. People went, well, okay, now I need to negotiate and talk to the
Hmm.
United States, and we need to, they're serious about this. But then, then that kind of happened throughout the summer. But then there wasn't really any kind of like official, not big trade deals were not really signed in. And then you had the lawsuits and then the Supreme Court decision. And so that the tariff policy sits in this weird spot. We haven't heard about it because the war is taken over. I think the administration is going to want that to kind of just unwind,
Okay.
and so I think the tariff rates will stay there. So I don't think they're going to take those rates away. But I think the tariffs as a policy tool have probably been passed. And so we live in this world. And to be fair, I don't think the next administration, whoever it is going to reverse those things. So if you're someone that is importing things in the industry to build things, construct things, whatever, like I think you're looking at some level of tariffs going forward. They have not caused the economic damage
Hmm.
that policymakers will respond to, is the way to say that. And so
Okay.
they're going to get some money coming in. Um, how that looks, I think, is still being worked out by the courts. But this tariff thing it started under Trump one, and it didn't stop under Biden. And so I think we're just kind of entering a new world. And by the way, I'm going to abstract out. If you've got business in other places, other parts of the globe, this is a new regime. Like free markets are under duress, right? We're kind of moving back into a very mini version of the mercantilism of the 17, 1800s. So I think
Sure.
there's some level of like expect that going forward. If you're importing stuff, expect there to be like more hostility in the trade space.
Hmm.
And so I don't know if it becomes like at what point it becomes smart to play locally more and have that reindustrialization versus just eating the cost of stuff coming in and what the people you're financing are doing. These are really big open questions. I will say this, outside of the data center space, I don't think there has been a ton of reindustrialization in the United States. It's still very expensive. Now, that doesn't mean it can't happen going forward, but I think a lot of the demand we're seeing for those kinds of things and those projects and the financing on those projects are related to one type of build, right?
Okay.
I don't know. Are you seeing that? Are you hearing that? Like that's an anecdotal thing as much as a data thing, in my view.
I think it's still all over the map, as you said. I think it's something that everybody faces, but until you're in that situation where it's impacting your business, it's just kind of out there and maybe not as impactful as it might have seen when you hear it on the news every day.
Yeah, I think that's a good way to put that.
Yeah. Okay. Let's come back to ELFA data resources. I know you've been working on the CFI, the CapEx Finance Index, for a while. That is a product that measures 5 different performance metrics. And I want to loop it into this new economic outlook so that member companies understand how they can utilize these resources to improve their own business and decision making going forward. Can you talk a little bit about the data that you've seen in the CFI and what that looks like, and just offer some practical application for using that information on a regular basis?
Yeah, so one of the things that I believe, I've forecasted, I'm going to pat myself on the back. I forecasted for John Williams, who was the San Francisco Fed president, moved to New York. I forecasted for Mary, done at the IMF. I've been doing this a long time. And there's a lot of humility in it. There was before the pandemic. There certainly should be now by economists. And so philosophically, I believe very much the point estimates matter, but thought and strategies and scenarios matter even more. And so you'll notice in the economic outlook, there are 2 scenarios, right? There's kind of a baseline scenario, which was the war, which we've now lived. So good thing we picked it as a baseline, that the war would end somewhat shortly after we posted that. And then there was the alternate scenario of the war would continue through the summer. We ran both through the models. They include both macroeconomic variables, and then we included forecasts for ELFA specific things like the CapEx Finance Index. And so the reason I want to contextualize this with the kind of my philosophy of forecasting is those are the kinds of things that you want to have a discussion about, right? If the economy does A, this will look like B in here, and if it does X, this will look like Y. And so there's a slide in there that has a forecast that's related specifically to the 2 scenarios we picked for the CapEx Finance Index for the year, right? So we forecast out and said, hey, we had a historic start to the year on new business volume, like historic start. And so we said, okay, given that, and given these 2 scenarios in our models, and our judgment about what makes sense and what doesn't, what do we, where do these numbers come out? And so, in the baseline scenario, we're set to have a really strong CapEx, from a new business volume perspective, a very strong year, the best year ever. And then when you ran that same thing through the kind of lower scenario, the downside scenario of a prolonged war, you got another forecast that still showed, yeah, there's going to be less new business volume, but it still is going to be better than we saw at the end of the last expansion. Now, I'm bringing this up for 2 reasons. One, that shows you the resiliency of the industry, because a prolonged war is pretty substantially impactful from an economic standpoint. But 2, this is how I would hope folks have a conversation. As a macroeconomist, this is how I would encourage you to have a conversation, right? There are infinite numbers of scenarios we could draw up. We selected for you a confluence of scenarios. We picked one theme and then some sub-themes off of that and said, this is one world, this is another world. This is what those 2 worlds could look like. And then that is like, okay, in these 2 spots, you're now in a much smaller information set. What should a equipment financing company do in those worlds? That's the question for y'all.
Yeah.
Right. But we wanted to set it up for you in a way that wasn't like, overwhelming. Because to go back to the beginning of this, there's tons of information, there's tons of uncertainty. I view my job as a macroeconomist and our job at ELFA to help narrow and throw out the stuff that is unlikely or not as useful, and then provide folks a foundation to have those strategic discussions inside their organization.
Yeah, I think that's an important note, that we want to kind of quiet the noise that's out there and really focus the resources that we are producing so that they are of highest value to this industry audience. So I hope that's what people are receiving when they look at these. And Tim, I want to ask, as we kind of close out our conversation, knowing that this is a quarterly deliverable that you and I are going to be talking regularly, what is one data point that you think could be the one to watch as we move forward? And, what is it, and are you anticipating that it will go up or down in our next quarterly outlook?
So, I mean, Mr. Warsh is going to have us evaluate all the data we're looking at. But for this time,
Uh-huh.
the one I am mostly watching is the month-over-month change in core PC. For now, that's still the Fed's number one inflation gauge. And I want to go back to what we started with. It's going to be really interesting. The war ended before the full impact, in fact, only a fraction of the impact in our estimation from the energy price increase based on what historically has happened occurred. And so because businesses and markets and consumers are forward looking, the end of the war has already pulled energy prices way down. So we were anticipating a fairly high month over month change in core PC coming from this kind of pipeline of inflation from energy prices. But now that that's rolled off and we haven't had the effect yet, did that just kind of leak out of the pipes and we don't get that inflationary pressure, which is kind of where my gut is going, and we have all these buffers in place? Or was it too late and we're going to get that inflationary pressure into the rest of the economy that from what happened over the last 4 months, and so 3 months. So that's where I would say, like, watch that month over month core PC number. That's your current rate of inflation, not just what happened over the last 12 months, but like what happened last month. And that's going to be a really interesting story. It's going to dictate, I think, everything that comes out of the Fed over the summer is going to be related and closely tied to that number. So watch that month over month core PC number.
Okay, well, we will check back with that when we meet again. Tim, I want to thank you for joining me in our sort of launching conversation of this new product. It's been really interesting, and I really appreciate you sharing your very valuable expertise with our audience. And for all of our listeners, Tim and I have talked about this new deliverable that we hope that you will check out. You can download it from ELFA's website. And we will be back with you in a couple of months to talk about what's happening in our next quarterly update. Thank you.